What the Fusion positions are, of course, are the married puts that we enter for the Fusion subscribers at Radioactive Trading. Ernie and I post our actual trades. We're just going to review my trades today. And I want to talk about recent updates to the Newmont mining position, the Schwab position, even more, but still good, and ANET. And unfortunately, it didn't capitalize ANET as it should have, but Arista Networks. So let's go ahead and pause the screen. And we're going to navigate over to the Power Options suite of tools. And we're going to take a look at the portfolio to show us what we did with 2 of those 3 positions, what we didn't do with 1 of those positions, what we might do with all 3 going forward. So here we are at the main Power Options screen. And I'm just going to navigate to the My Portfolio tools. And we're going to go right to Portfolios, where we're tracking the open positions. Well, let's start with the basic one. Here's Arista Networks, originally bought back in October at a price of $120.47. We originally bought the 125 strike put for protection, a risk of about 6.5%, I think 7%. We've made some adjustments, rolled up the put, sold some premium against the position, so we have a lowered cost basis of only $118.37. But the stock is down $115.13. It was up as high as $135, and it's dropped. The put still is retaining a lot of its initial value. We're $1.95 profit on the put, but the stock has dropped, as you can see, $5.34. But we've been in this position for about 100 days. Is it at a profit? Not yet, but we're going to look to evaluate some of the adjustments on that position. I was considering rolling down this put when the stock ANET was trading at around 120. It's one of the income methods discussed in the blueprint. So right now we're only at a risk of 2.4%. Protection out to March, not that long. We may look to extend the protection with a different strike. Currently at about a loss, near the full loss of 2.4%, of only about 2.1 or so. But taking a look at the stock chart here, sorry about that, folks. It's hovering around this 115 range. You can sort of see that here after that big decline in the tech market, which happened from about mid-December to beginning of January. It tried to claw back up, sort of trading around this 115 to 118 range, and then dropped again down to 112. It's back up into this 115 range, as you can sort of see here. So we were considering lowering our 130 put down to maybe a 120 strike, or down maybe to a 125. And that was in this time frame when it started to recover. I was kind of glad I didn't here. But again, we still have opportunities if this starts to show stability again and stay within this range to take that small profit out of the put option, but actually extend the time on the position, lower the strike, continue the trade, and do more. Now keep in mind, we're only down 2.4% on the position, even though we've seen a decline from almost 140 actually down to about 115. Good protected position. Good income method adjustments leading up to this time frame. We like where the position is now. We want to do more with it, of course. Is it meeting our goals? No, but having only a 2% loss on the position right now, when the stock is down 4.4%, a very small win, but we're going to look to adjust that position. Now, let's get into the complicated positions. Not so much complicated, but a little advanced income methods from the blueprint. We did 2 different riskless spread trades on Newmont Mining and the Schwab position based on our goals and expectations. So we've been in Newmont Mining almost the same amount of time as ANET, 112 days. Originally bought the stock at $42.32, and we have a cost basis of $43.77. So we should be seeing a loss on this position, even though the stock is up 26%. We've increased our cost basis. We originally paid $5.20, or at one point we paid $5.20, for the March 47.5 put, which is now only at 83 cents. So we're losing on this position pretty bad just looking at those numbers. But that doesn't tell the whole story. There were other income methods done in this position. Oh, this isn't accurate, actually. I apologize. This is a negative risk at this time of 1.6%. A little bit different now. Let's go over to radioactive trading. I apologize. And let's go to the open trades trade tracker from the Blueprint Fusion. The Newmont Mining is a bulletproof position. It was bulletproof at 1.6%. Now it is only 1.4% because we reduced the cost basis, down in time. So let me just take a look here. I want to see something. Before I did that recent adjustment, we lowered the cost basis down to 46.70. You can see here we sold some calls against it, moved up the put from the 45 initially to the 47.5, and continued to reduce risk on the position, and we received a dividend payment as well. So why am I going through all of this right now? Well, taking that cost basis that we had of just about 46.70 rather than, that's still not right, but okay. No, that's right. I mean, it is bulletproof position. I think I'm missing something here. This didn't record some of the income methods we used, obviously. My apologies. In any case, let's move on. We did an income method number 6 on the Newmont mining position for the Fusion subscribers. And what we did when the stock was trading at around 51.50 or so, we sold today's 52.5 call for 93 cents and bought the 55 call for today's expiration, a higher strike. We have the low risk married put in place, essentially sold a call against it to generate premium, and we took some of that premium, a little more than a third, to buy the 55 strike call. So if the stock continued to move up in price, we'd still have an infinite upside. Even though the stock gain is capped by the sold call, just as you would see at a covered call or a collar, adding the extra long call at a third of the cost roughly leaves the upside open if Newmont Mining really took a run into the first few weeks of January. Now, that didn't happen. Leading up to today, Newmont Mining was doing exactly what we would want. It was accelerating to the point where our upside was still open, since roughly we entered the trade was around this price here. And then it pulled back down. It was trading just at around 52.50 a couple times. And then today, it sort of moved back up right at the end of the day. So we had to manage the position. But we took in about that 60 cents of net credit against the risk, which bulletproofed the position. And for the Fusion subscribers, what we did is let this long call expire. We could have only gotten maybe 1 cent for it. And we rolled our 52.5 call for today's expiration out 2 weeks to February 3rd at the 55 strike. So that took our bulletproof status from 1.6 down to 1.4. We're still in a strong profit range on this position, but that was the adjustment that needed to be done. We didn't want to get assigned at 52.50, even though we were still in a strong profit range based on the cost basis of the total trade, roughly about 8.5%, 9%, I believe. So we moved that position up to sort of to keep the trade bulletproof status, give ourselves a little bit more upside, and of course, keep the premium positive. That's what was done with the income method number 6 adjustment on NEM. And Fusion subscribers, you'll see more on that a little bit later. Now, Schwab position. Schwab was trading roughly around 83.40, 83.50 on the 6th of January. It's above our put strike price that we initially entered. We've been in the position for 24 days. Now, I had a sentiment that Schwab and the banking might still stay strong. Boy, did this week prove me wrong. I didn't see some of the faults that were there. Possibly should have, possibly could have, but I didn't. In any case, that's okay. I entered an income method based on my expectations that Schwab would be trading just around 85, maybe somewhere between 84.50, 85.50. Maybe it went up to 86. Maybe it only went to 84. That's what I was looking for. And we bought the 82.5 call for 335 and sold 2 85 calls for today's expiration at 195. So we paid 335, but we took in 390. We did a ratio call spread, what's income method number 5 in the blueprint. What's the risk of a ratio call spread where you're selling twice as many calls as you're buying? So in that case, you'd have a naked call and infinite risk. In the construct of the married put, I simply just have a covered call position. One of these two short calls is sold against the stock. We have the protective put in place, and then I have one bull call debit spread by buying the 82.5 call and selling the 85. This is the profit and loss chart that we had for Schwab at the time. Remember, the stock was trading around here at about 83.50. If the stock hit my target range somewhere in here, what would happen? Well, we've got the positive premium of 55 cents from this ratio call spread, which reduced our risk on the trade. An income method done in the first 24 days of the position. And this acceleration of gains we see up to 85 is due to the profit that could be taken on that bull call debit spread, buying the 82.5 call and selling the 85, with the stock price still gaining and still having positive delta because the delta of the protective put is lower than that of the one delta for the stock ownership. That's why we see that acceleration. Why did I do this income method? Excuse me. If the stock was trading in that range, we got the positive 55-cent premium from the ratio call spread, and we'd be able to close out this bull call debit spread for another gain of about close to 250. If the stock was trading right at 85, that would have been a profit total of 305 for the first income method done against the Schwab position in the first 24 days. However, just like some of the other banks, unfortunately, the stock was trading right in the desired range here, leading up to earnings. I figured Schwab would have a normal, tame earnings, only move up maybe 1.5%, 2%, or drop 2.5%, 2%. But as we can see, the stock dropped down to about 79 or 78 the first day after earnings, dropped another 3 or 4 points down to 76. Came back about $1 today to be at 77. Did I pick the wrong income methods? Well, there are pros and cons to each one. Hindsight's 2020. An income method number 5 might have been better on Newmont Mining, or just selling the call in the position might have been better on Newmont Mining. Originally, I chose this income method number 5 for Schwab because if I was right, based on my expectations, I might make as much as $3 for this income method against the position. Where had I just sold the 85 call by itself, we would have made $195. So not quite double the profit, but a good increase that accelerates the profits from just your standard selling a call against the married put or income method number 1. Hindsight 2020, that did not happen. I would have been better taking more profit knowing the outcome now of just selling the 85 or maybe the 84 call by itself, or getting more premium with the income method number 6 that we did on NEM. But again, we reduced the risk by 50 cents. Both of our calls expired worthless. We keep a risk of only 6.5%, just being in the trade 24 days. I'll take that. The position is at a small loss right now because we still have time out to June on the put option. So we're going to look to potentially adjust this structure as well. Keep the distant time frame, take the profit off of this put that we had that we only paid $6.75 for, and it's I think worth about $8 right now or so, and lower the cost basis on the position, restructure the married put. It's another income method in the blueprint. Or I might decide to use an income method number 12 based on my outlook going forward. So again, that's just some of the review of what we have in the radioactive trading portfolio. Let's bounce back here to the open trades trade tracker. You see some of Ernie's positions. He's got 2 bulletproof positions right now and 4 other positions open, a couple that he just opened recently within the last 11 days. And I'm looking to open another 1 or 2 as well. But as I mentioned, Arista, yeah, it's only down to 1.8%. Charles Schwab is only down about 3% on the position, even though the stock fell from that 83 range down to $77. 6 to 7 point loss on the position, but we've got controlled risk in place that we reduced with the income method number 5, and then we just let that expire. We did this as well. I'm sorry, Shishir says, if Schwab keeps falling, would you roll down the put? Well, I'm in the position now where I am likely going to roll down the put on both Schwab and ANET. Although ANET's been more temperamental and hasn't been holding that, I want to give myself a little bit more time on ANET. As you saw, Shishir, I just had the March put. So I'm looking to roll that down as well. Now, the fear is if I roll this down and out in time, I'm sorry, the ANET, if I roll this down and out in time, I'm going to be taking a higher risk. So if ANET keeps falling, I might lose more. But again, I want to follow my expectations. That CEGA model we discuss in the blueprint for current conditions, expectations, goals, and that determines my action. If Monday, Shishir, I wake up, well, of course I'm going to wake up on Monday, knock on wood. But yes, absolutely. If Monday comes around 9:30, the market opens and Schwab opens down another 2 or 3 points and is at 75 or 74, absolutely. I might evaluate other income methods I might consider doing at that time rather than just rolling down the put. This is one of the great things about the married put position in general, of course, as you know, is let's just go ahead here and go back to the profit and loss chart. And let's just clear these out and take our 55 cents. We're just going to drop it down to 81.50. Not account for that, accounting for close to that extra 5 cents. There's our 6.5% risk, but it's out to June. So even if the stock falls a little bit more on Monday, let's go ahead and do that. What would happen if the stock fell to 74? About another 3 points, Shishir, on Monday. My total loss would be 447 on this position. In theory, it's getting close to that 5.5%. But what am I not forced to do? Still have 147 days out in time on what the position is going to look like after we account for the calls expiring for income method number 5. I'm not pressured to make an adjustment on a daily basis because the stock fell, as I would say with a 1 week out covered call or weekly naked put. I don't have to react to the market. I can wait and see if the market starts to recover. I don't want to wait too long. Don't get me wrong. We did an income method. We reduced the risk in the first 20 days, really in the first 10 days when we open the position. We're going to wait to see what happens next. If it hopefully stabilizes and starts moving back up, which I'm hoping for now, not hoping for, but that's what I'm sort of expecting, even if it takes a week or two, I'll maybe look to still roll down the put, but then start doing other adjustments, maybe another income method number 5, actually, based on my outcomes. But if it keeps falling and I roll down the put, I'm going to have to analyze at that point, just as we talk about in the blueprint, why is it falling? Is it market-wide? Is it related particularly to the stock or the sector? Is Schwab now underperforming? That's going to lead me to the action, applying my CEGA model that's discussed in the blueprint for each of the income methods and the structure Shishir as well. I may not roll down the put. I may do another adjustment where I can profit to the downside. The best play on ANET, of course, was doing a income method number 12 once I started to see this and then this. So it would have happened maybe around here at the 125, 126. Income method number 12 would have been the best play. Again, hindsight 2020. I didn't expect the moment. I didn't expect that steep of a decline. It was related to the sector. It was related to tech. And, of course, not directly to stock. ANET's still a strong stock in the industry as well. And your follow-up question was related to something that Victor proved me wrong on. Right around this time, we had a discussion about income methods I might do for ANET. And Victor said, wouldn't it be better to liquidate the position for the 4.5%, 5% profit now rather than risk a further decline? And I didn't think so at the time. I wasn't expecting more profit, but I hadn't hit my goals yet. So again, following what's in the blueprint, Shishir, the rules, the guidelines, there's a chapter on exiting the married put, what you'd look for, setting your goals, and so forth. If Schwab keeps falling, I may exit the position for a small loss. I more than likely will adjust the position to lower the risk, maybe even further lower the cost basis and potentially turn the position into a profit, Shishir, rather than close it now for loss. It's at that small loss I showed you of 2.4, 2.9%, if I remember correctly. Schwab's, is at a liquidation loss around 2.9, 2.7% right now. So I have a feeling it'll come back. I have a feeling it's going to recover. It might not be Monday. It might not be Tuesday based on market conditions. But even if it just comes back to 78 or 79, I'll probably be at break even on this trade potentially. Or I'll have an opportunity to a better adjustment based on the new trend going forward. So, but if it falls to 73, 74, 69, 65, 60, well, the most I can lose is 6.5%. I don't want to lose that. Is it better to close now at 2.9 than risk the 6.5? Possibly. But even with the earnings that came out with the banks and the financial industry, and you can disagree with me, that's perfectly fine. You could have different analysis. That is perfectly fine. I still think that this will show a little bit more recovery and a little bit of a bottom out and stabilize. And that's when I'm going to look to do my adjustments. So I think it might actually be there, but again, it's only 2 days after earnings, so I want to give it a little bit more time to show its hand, for lack of a better term, and for the market as a whole to show me its hand also.